Welcome to Turbo Impact, where we navigate sustainability in private capital. I am your host, Kenny Chen. Each episode, we sit down with investors, allocators, and corporate leaders shaping the next era of sustainability. We explore how capital is driving the global transition and how today's decisions are shaping the future of impact. Thank you for joining us. This podcast is brought to you by Turbo Net Zero, a pure-play sustainability advisory firm driving impact across the private markets. In this episode, I interviewed Cary Krosinsky, a leading educator, author, and advisor on sustainable finance. Cary is a co-founder of the Sustainable Finance Institute. He teaches at Yale, Brown, NYU, and Harvard. He has also written extensively on sustainable investing, helping to shape the field's evolution over the past 2 decades. We discussed the evolution of sustainable investing, how general partners and asset owners are responding to today's market dynamics, and what's needed to prepare the next generation of sustainable finance leaders. Here's my conversation with Cary. Hi, Cary. Thank you for joining Turbo Impact Podcast.
Great to be with you. Thank you, Kenny. Thanks for having me.
You've been called one of the architects of modern sustainable investing. What first sparked your interest in this work, and why did you stick with it through the early days?
Yeah, thanks for that. It's been an interesting journey. I'm probably more of an observer of the field, and I've tried to kind of you can't really steer a big ship, but I've tried to kind of nudge it a little bit to make sure it's heading in the right direction. Since our first book in 2008 on the subject, and we've done 7 books on the subject, and we'll have an 8th coming out, I'm sure, sometime soon. And we've been teaching since 2009 every year. I think I'm the longest running teacher on the subject of sustainable finance. And I find it intriguing. It's a constantly evolving field. Climate change in particular is an ever-pressing issue, and there are many complexities. So it's been fun, and at the same time, it feels arguably somewhat impactful. We really enjoy interacting with young people who are thinking about their careers, and as I'm sure you know, trying to encourage more positive progress. So I think we've had an interesting role to play, and hopefully that will continue. And it's an interesting time for those of us who've been trying to foster more sustainable finance.
You've worn many hats, educator. As you mentioned, you've been teaching this subject for a really long time. You're also an author, advisor, institution builder. Which one do you find most fulfilling today?
Yeah, what's most important? It's interesting. I really like bringing people together to try to find common ground. So whether that's my lack of success at improving U.S.-China relations for solving sustainability challenges, I'll continue to push the essential nature of that, or bringing asset owners together on a global basis to cooperate and collaborate. Probably the encouraging cooperation and collaboration in a positive way is the most important work that we're helping with, and creating opportunities for students. So we've helped give birth to a number of organizations, and create opportunities for students as well. So we're really keen on young people having more power, more influence, because they largely care about the same issues I do, as opposed to, say, people over 60 who have other things on their minds. So the combination of helping students, helping young people, and encouraging more positive cooperation and collaboration, those are the 2 most important aspects of what I try to do.
When you think about where sustainable investing is headed next, what's the shift you are most interested in helping drive?
Yeah, one of the things we try to do when we give talks or teach is make sure that there's a better understanding of what's really going on. So I think that's been a problem for a long time. Actually, people mislabel the field or they exaggerate what's really happening, um, or misrepresent for various reasons. And so the first thing to understand is that there are 7 very different and distinct investment strategies that investors use. And so making sure everyone understands that first and foremost. That's the 7 of what we call the 3, 5, 7, 10. We believe there are 10 misunderstandings about ESG. The fact that ESG is not a single thing. People keep talking about it that way, which is people should know better than to do that. There's a whole variety of environmental, social, and governance specific issues they present as risks and opportunities. And perhaps most importantly, there are 5 categories of potential impact that we can have. And I think that's also not well understood, that there's companies, both public and private. There's investment writ large. There's innovation, which US and China are each leading on in their own ways. There's policy, but policy won't be in place unless the people want the policy. And that's true in China, where a majority of people want progress on environmental issues that perhaps they've experienced in their daily lives. If the air quality wasn't great, for example. So where are we? We actually haven't been as robust a field as people kind of wanted to admit. I think there have been a lot of attempts and a lot of noise and a lot of philanthropic pushing of different agendas. And the reality is that we haven't made enough progress, clearly. Climate change continues to march on. It was always going to be a big challenge. But we're learning what does and doesn't work. And when we learn what works, then we can figure out what we can scale for purpose. And that's true, on a country by country basis. So, China's making great progress. Even this week, we're hearing, encouraging things coming from the government when it comes to, climate and technology. And there's been good progress here as well. But what there hasn't been good progress on is working together to make more progress. So I think there's some groundwork that can be built upon, and there are some unnecessary obstacles to success that need to be removed, and they'll only be removed if people want them to be removed. And we have to get out of this mindset people have gotten in that, ESG, we can't do ESG for whatever reason, whether it's political or the returns weren't great the last few years for certain approaches. The reality is, we have issues. We either deal with the issues or we don't. And either we can use investment to make progress or we won't. And if we give up, that'll be a bad result. So we have to keep trying.
Thank you, Cary. I want to dive into the technical side of sustainable investing and pick your brain a little bit more here, since you've observed this field from the beginning. And what's your current read on where sustainable investing stands, and what's evolving and what's still stuck?
Yeah, that's a great question. Thanks, Kenny. Yeah, I'll refer back to the 7 different strategies, and I'll get more specific about what those strategies are and where they are, where each of those 7 categories is. So when you go way back, and this is now 2 generations ago to the 1970s, so-called sustainable finance, call the field what you want, really started with negative screening. In the US, you had the idea that not investing in weapons was something to do, or tobacco has been an issue at times for investors. In the UK, you have ethical investing, which tends to come from religious mandates. If you go way back, you have Sharia investing, which, while practiced as negative screening, typically is actually more not allowing for fixed income, because the idea was that if you believed in a project that you were going to lend to, then you should participate as an equal owner. So then this goes back before Islam. So the idea of the shared economy actually goes way back, and we've come full circle in a way to more circular ways of doing business. But the negative aspects, this is kind of where things started. It's like, oh, I don't like that. I don't want to be involved with that. Just invest as you will, Mr. Professional Investor, but I don't want to invest in these certain companies or sectors. And that's still an issue. It's still an attitude, but it's kind of a human nature approach to things you don't like is sort of, kind of not want to be involved or be personally liable or even responsible for the issues. What we've learned over time, and we've been pushing this pretty hard for 10, 15 years, is that, divestment strategies don't work. They have not worked. They were never going to work. Going back to 2013, our first interactions with students at Yale was around this question of, don't put all your time and energy into divestment. It's not going to have the effect you might think when it comes to solving climate change. Rather, we should pursue positive approaches. And this has been the nature of our books, going back to our first book in 2008, where we called for a move from negative strategies that weren't performing well financially. At best, they meet market performance. They often provide lower financial performance. And most people think sustainable investing is exactly that, not investing in certain things, limiting your universe, and ending up with a worse financial result. The reality is that's only one of the 7 strategies. We have a lot of time for positive approaches, and there are actually multiple categories of positive approach. You have positive investors like Generation Investment Management in London and many others who've gained tens of billions of dollars to manage, and they try to find companies that are managing their risks well and otherwise investing in solutions while also being mindful of their financial outcomes. So you can try to maximize financial returns and invest in a sustainable manner. And we've had a lot of time for what's called the positive best-in-class approach. So what do I want to invest in? Because I think it will add value, financial value, and societal value, versus what do I not want to invest in? 2 very different approaches. The other positive approaches include impact investing, which has reached $1 to $2 trillion. Positive best-in-class is probably more like $5 trillion. Impact investing tends to be private investments in opportunities for those less well off. And so that's, again, a very different category than investing in, say, public companies. The 4th category of the 7 would be thematic investing. So that would be things like renewable energy project finance or water infrastructure investment. I think you have is that New York City, the skyline behind you?
Yeah.
Yeah, New York's full of banks that have made, $1 trillion+ commitments to sustainable finance, and it tends to be in the thematic category. And here's where you also see green finance and, sustainable bonds and those sorts of things. So that's where, a lot of the scaling up really needs to happen, scaling up renewable energy and other forms of lower carbon technology. Again, a very different category than the first 3. The other 3 are shareholder engagement, more of a Western concept of investing in companies to have a conversation with them about how they can improve their practices. ESG integration, which is where you see greenwashing concerns, just taking data in from providers, which doesn't really answer, the data isn't perfect, has problems, doesn't really answer the questions of the day often. So just taking an ESG integration approach by bringing in data is insufficient. And then you have minimum standards, which we're a big advocate of. In fact, New York State Common, we've been an advisor to and suggested minimum standards as a way to bring different advocates for negative screening together with those who believe in engaging with companies around a common agenda. And the largest investors in the world, like Norges Bank, have taken this approach to heart for a long time. Like if you're in Manhattan and you visit a restaurant, there's a letter on the window, tells you whether the food is safe to eat. It says grade pending. Why would you go into the restaurant? Food safety is a big issue everywhere. On the other hand, we don't really have that, or haven't had that historically when it comes to investing sector by sector. So you were a big advocate of encouraging minimum standard approach because that could lift the tide of all boats. And I think there's a lot of potential for that in Asia as well. So those are 7 very different strategies. And so we have to sort of look at them individually to figure out whether they're effective if they were scaled, would they be, what level of scale would it take for them to actually have the impact that they were intended to, and what's actually working and not working from a financial perspective. And each of the 7 categories has a different story to tell, and I'm happy to go into that if that's useful.
It's a master class within several minutes, Cary. So I'm very interested in learning more about you've done a lot of research on private equity, GPs, LPs. So how are the private equity GP LPs approaching sustainability today? And why does it matter? Why does sustainability matter for long-term value creation for this group of people?
Yeah, it's a great question. Thanks for that. Yeah, it's actually a core focus of our work today. Uh, a lot of sustainability focus over time has gone into public companies, which is fine. And public companies are important, but we've seen the rise of not only venture capital but private equity as major asset classes. So, and as far as we're concerned, a private company is a private company, whether it's state-owned or owned by Blackstone. I don't care; they're all the same. Uh, so, if we're really looking at companies and their impact, we have to consider the importance of private companies globally. So I think that's increasingly recognized. That wasn't the case, but now, for the last, say, 3 to 5 years, it's become an increasing focus of many, including the work we do at the Sustainable Finance Institute, a think tank that a good friend of mine in Shanghai and myself created back in 2018. We've done a whole bunch of things, hosted events, worked on a better index for China, and now one of our major focuses is the future of private equity. So what we're seeing is, first of all, regardless of the anti-ESG tone in the U.S., asset owners like pension funds, endowments, and are looking really closely at this question in many different ways. And our work encourages LPs to work with their GP partners to make progress. And we have a process for that, and we're hoping to come out with some reports. We'll certainly well over the next year. We're actually working with asset owners in a private setting on this topic. So informing them about what's the best process. There are other organizations that have put process together that we're learning from, and we're learning from our asset owner partners. What we see is no slowdown whatsoever on focusing on sustainability from asset owners whatsoever. If an asset owner has made a commitment, they're sticking with the commitment. We haven't seen literally any walk back on any commitments or strategies that have been deployed, which is very good news, I think. In fact, when you talk to leading private equity firms like TPG or Brookfield, the ones that have the better funds that are climate specific, they're only getting more assets to manage, right? So there's been no slowdown from European asset owners or the blue city U.S. asset owners or university endowments as well. So that's good. What we find is that the asset owners are doing their own due diligence. Sometimes they'll hire consultants to help them, but it's such a opaque and unique field that it's really only recently that the processes have become more clear and the ways to drive progress have become more obvious. And there are other trends playing out that make it interesting to watch and observe and work on. On the one hand, I think private equity is financially threatened. We're seeing a lot of concern about, are the values real? When you mark to market, what's the real value of these underlying companies? Fewer IPOs are happening because of market conditions. So that's not ideal for the private equity firms, that they're having to hold on to companies longer than they intended. Some university endowments, given the pressure from the current administration in DC, are selling private equity, like Yale and Harvard and it'll be interesting to see what the valuations are of the portions that they sell, what they decide to keep and not keep. But the field's fairly opaque, so it can be hard to know exactly what's going on. But I will say that the asset owners that we work with are full speed ahead, and you can see some of the work that makes the public domain. There's other work that's either happening in the background or is being developed. And to the last part of your question, why is this important? Asset owners are long-term investors, and there is no long-term, actually. There's only a series of short terms. So, on the one hand, asset owners, pension funds, university endowments have current short-term obligations to their beneficiaries or to their institution to make sure that they have the proceeds they need to operate. On the other hand, they have long-term goals of keeping an academic institution solvent and successful, or paying beneficiaries 10 to 20 years from now. So they all have to be mindful of where things are going to go, especially in the 2030s, which are likely not to be business as usual. In fact, scientists tell us that's basically impossible. So if you believe, it's not even a belief, if you do the math, if you do the analysis, and you're a long-term investor, and private equity is by definition a long-term investment, you basically have to look at these things. And so, the interesting asset owners are like Texas retirement system or Florida, where, there's sort of a conundrum that they face because they know these risks are there, but they have, an inability to deal with them. Are they going to be stuck? Is the question the reverse? Like, if you're an asset owner, why wouldn't you look at this? And if you're not, are you going to be left behind in some way?
Thank you, Cary. You mentioned different GPs who has been doing pretty well in terms of implementing sustainability. Could you also share a few examples or findings during your research and interaction with these GPs?
Yeah, what's interesting is that pretty much all of the large GPs have had to create some sort of a climate fund, right? All of them have them now, whether they have the word impact in the name of the fund or the word infrastructure. Climate sometimes makes it into the language, but it's really the demand from clients or the potential demand from clients that's driving this, right? So one of the things that you see with asset owners, LPs, is that they don't really want to change their relationships, right? So if you're already working with KKR or whoever it is, by and large, those have been, successful enough relationships, right? They're not going badly. The asset owners don't really want to break those relationships. Once those relationships are established, they're hard to change. They're hard to shift. But when you have new allocations of capital as an asset owner, that's when you can have major influence, right? As opposed to, say, a 10-year contract that you're just working through. So there's a competition for those new tranches of capital, and asset owners who have that capital, there's like this 80-20 rule of money from blue states, blue cities, and other parts of the world that are taking sustainability seriously. It's like 80% of assets. It's not to be ignored, to say the least, even if the 20% make anti-ESG noise. The 80% is where the competition is for future AUM, right? So as a result, GPs are, even if they don't believe in climate change, and increasingly they do because they're realists, right? They need to provide adequate product and an adequate product mix for the day so that their clients are satisfied. So the asset owner demand is the major part of the equation, both current demand and perceived future demand. And I think that's driving a lot of what we see.
Can you share a little bit more about your research future of private equity?
Future of private equity, sure.
Yes.
Yeah, we have a 9-step process that basically calls for creating a baseline understanding of where a GP is. And then we provide recommendations for having more impact while also being mindful of the bottom line. And then we take a second snapshot because, and this is true with all sustainability analysis, it's inadequate to take a snapshot in time at one point in time and have that mean anything, really. It's just a picture on a wall, if you think about it. And that's true for ESG data as well. What's more important is, 2 points in time and measure the change, the delta, right? That's really where you can see if a strategy is having meaningful impact, because if the score stays the same, we have our own culture score. We think culture is super important. If that score doesn't change, then nothing's changed, right? The organization is exactly as it is. So that's the main driver of our work, is to uh, look at the change and see if the change is happening at the pace that might be required, but also, to inform asset owners on what's the best process for themselves and for their beneficiaries. Yeah, we've done some work. It borrows from we created a company called Real Impact Tracker back in 2017. It did an academically rigorous study of the impact of strategies on a relative basis, and that was kind of brought forward to the present time and adapted for private equity.
From and also from the LP forums and the conversations you have been leading, you share a little bit what's still on asset owners' priorities right now. What else you think are on top of their mind for the institutional allocators right now when it comes to sustainability?
Yeah. I'm going to turn that question. I'll ask you that question and then I'll answer it. How's that? What do you think's on the top of their mind?
Well, from my observations, definitely how to implement these sustainability programs cohesively with the different GPs and portfolio companies, right? And especially given that you have a really large and direct investment program, it's pretty challenging for you to manage sustainability and keeping track of those impacts right now. So we'd love to learn more about your insights when you are dealing with these the most influential allocators in the world. Yeah.
Yeah, absolutely. That's certainly happening. I wouldn't say that's top of what's on the top of their mind. I mean, they're all doing that. Absolutely. There's no question that you're correct, that they haven't pulled back. They're having to make sure everything they do has a financial angle, but that was always true. That's nothing new, really. I mean, there isn't a single large asset owner that can do anything that is off of the idea of maximizing financial returns. That for all the focus on it, excuse me one second, I'm just going to take a sip. Something. For all of the focus of impact investors, you're not gonna see large allocators working with that word. That their lawyers won't let them, because there's an implication of lower financial returns, even if that's not what happens in some cases. So asset owners, they have asset allocation um, goals and risk return targets per asset class, and they have to stick with those. So the opportunity is to work within that framework and make as many sustainability decisions and establish strategies and commitments and allocations of specific capital to sustainable finance as they can. And they're all trying to do that. So that's all good. And they haven't taken their eye off of that ball at all. And they're trying to do new things I'm starting to see, which are also encouraging. But what's most on financial institutions' minds in the last week, we've had speakers come to our NYU class, uh, uh, asset owners, fund managers, banks. One of the bigger questions of this week is the US is about 60% of global market share. And, the value of, when you look across asset classes, it's sort of tilted towards the US in a way that might have made sense when the US, was, a technology leader and its companies were very successful financially, and it was seen as a bastion of freedom or what have you, and the US is the shining object on the hill or what have you, whatever the US used to be. But that's not what the US is anymore. And it really never was. US has always been a split personality, a schizophrenic country. with, half its people wanting one thing and the other half another, and it hasn't worked out, those differences. Say, unlike other countries where there's a bit more of a cultural requirement to look at climate change, like you see in Europe, balanced with their economic reality, or in China, where, there's a conundrum, understandably, about meeting, fairly aggressive climate goals, but at the same time needing to take care of its people and have a robust economy. And many countries face that. So, this idea that asset owners are so tilted towards U.S. investments at a time like this is causing a lot of consternation. And I think that's the biggest thing in people's minds right now. You have a Trump administration that is, continuing to cancel projects and grants, and the U.S. used to be a science center for the world. China was already a leader on science and technology, and it will probably, only become more of a leader given the U.S. abdicating that role. And, so what does that mean for investors, right? Innovation has come from the U.S. and China primarily, really, over the last 5-10 years. What if the U.S. stops being as innovative a country as it has been? What does that mean? So that's what I see as top of mind. And for me, there's this enormous strategic opportunity for any country to seize leadership on sustainability, because if you do that, that's a competitiveness issue. And again, if you're an investor, and you're not investing in the most competitive country in the world, what does that mean? And every country has strengths and weaknesses and is facing different obstacles. But, ultimately, for me, solving climate change is a race, and it's inevitable, as Al Gore and David Blood like to say, and as a responsibility for financial institutions to be more involved. Well, that's fine to say, but the devil's in the details, right? So if you have a specific pool of assets to manage, you have to keep all these things in mind and try to figure out what's best. And yeah, it's tricky times for asset owners, and they know it.
You mentioned the asset owners are still on track of their decarbonization goal. I know you serve as a member of the New York State Common Retirement Fund's decarbonization panel. Can you share a little bit more about how asset owners are thinking about climate change and decarbonization specifically? Why uh, why why does it matter to their portfolio?
Yeah, absolutely. And there's been a lot of work on this over time, and some of it's better than others. But there are basically two concepts that experts have coalesced around when it comes to the risk side of climate change, and that's physical risk and transition risk. Whether it's the task force on climate-related financial disclosure or other efforts, they've all kind of coalesced around the same framework. So if you're an asset owner and you own assets, you have to sort of understand and even be able to report on, to what degree are your assets exposed to both physical and transition risk. We're in a time of great disruption. Forget about climate change, right? Technology has been rapidly advancing, and some of the most successful companies to invest in have been technology companies over the last generation. So you could have just put your money in the NASDAQ 100 and outperformed a more, balanced portfolio. So you have to sort of be aware of the secular nature of this as well. Climate change is real, so that's going to affect physical assets. And if you're an owner of real estate, you have to understand whether your property is going to be underwater, et cetera. And from a transition standpoint, given AI and all the other trends happening, to what degree are your existing assets going to be at risk of being left behind? The sort of dynamic that led to a company like Xerox or Eastman Kodak, both very inventive companies that didn't fully implement the innovations they were developing, and they went bankrupt and have disappeared, right? So if you're investing in just companies like that, transition risk might kind of not optimize your fiduciary duty or your responsibilities to your beneficiaries. So it is a fiduciary duty. It's your responsibility as an asset owner to think about these things and to make sure you're not missing something. And then there's the opportunity side of the equation. If and when climate change is recognized as the existential issue that it is, and will only certainly become more intensely, then you have to make sure you're not missing the biggest opportunities of our time. And if that was technology a generation ago, maybe it will be climate solutions for the next generation. And if you're not investing in the right technologies with the right investors, then again, you're running the risk of not optimizing your portfolio. And it's, you can get ahead of yourself, and that can be a problem too. But so caution and, wisdom is called for. There's something of a 2x2 of private investors, for example, right? You want to find the upper right quadrant investors, the ones that are seeking sustainability solutions, but that will also be the most financially successful. And you want to completely avoid the ones that are not looking at sustainability and are not financially successful. We did an analysis of public market funds 8 years ago, and there was one fund in particular that was managing, I won't mention the manager's name, but they were managing like 60, $70 billion, and they were underperforming the S&P 500 by investing actively in US equity over a long period of time. And that's the sort of manager you want to avoid. And most pension funds will invest with external managers. So it's only going to become more important to select the right managers. And so, these are some of the responsibilities of the day for asset owners.
You have built platforms like Carbon Tracker, Real Impact Tracker, and Sustainable Finance Institute. Can you tell us more about how these initiatives come to be and what kind of impacts they have been making to the industry?
Yeah, thanks for that. Yeah, and in addition to those, we've also helped catalyze other organizations. So in particular, I'm thinking of the Climate Tech VC newsletter, which you can visit at ctvc.co. We translate it through our WeChat for the Chinese audience. We introduced the two principals, Sophie Purdom, Kim Zhu, who we came to know as students at Brown and Yale. So for me, it's really important to help catalyze exciting new things, right? So that was a very successful free newsletter, still free. I think they had 80,000 subscribers the last time I checked, and they went ahead and got funding to start up their company, Sightline Climate, which is in London now and advises on climate to, especially with a core focus on VC. So they're basically the VC experts when it comes to climate in the world, and are pretty much generally recognized as such and great advocates. So we're happy to help catalyze things like that. Even if we're not directly involved otherwise, that's totally fine. Going back, Carbon Tracker, came through networking and my own desire to get into this space actually 20 years ago. I was originally involved with computer programming and analysis, and got an opportunity to join management. My second career was analyzing the financial system, looking at its behavior and its ownership. And from that perspective, I already had an intrinsic understanding of financial institutions. So again, going back 20, 25 years, we wanted to figure out how to use that information to try to make a positive difference when it came to sustainability challenges. Went over to London almost exactly 20 years ago, met people who were eventually forming Carbon Tracker off of what was initially another idea. So Carbon Tracker gave clearer vision to the idea that if we're going to solve climate change, we need to leave most of the fossil fuel resources and reserves in the ground where they are, and what are the implications of that. So that's been good work that's been happening for 10, 15 years. And I'm no longer on the board, but the organization's been somewhat influential in that regard. Real Impact Tracker, really led to our future of private equity work now. I worked on that with a few Yale students who spun off and have started their own business called Your Stake. So that's good to see also. And the Sustainable Finance Institute's where we're focusing most of our time now. So, we just think better US-China relations, better global relations more generally is essential. I did an article for the Itachi Sukin Journal calling for more Japan-China better relations. And I think we need to see just better relations between countries, kind of reversing this nationalistic, isolationistic approach, which is, not ideal from a solving climate change perspective. So our projects are global and they are collaborative by design. We have a lot of things that we intend to do going forward. So we see ourselves as a catalyst and an observer and someone who can help. Again, not maybe we're not steering the big ship, but we're just trying to nudge it in the right direction a bit more.
A lot of admirable works here, Cary. So I want to ask you, in the contrary, we are seeing backlash here in the States, right? So what's your take on the overall ESG backlash sentiment, and how should serious private market GP and LPs navigate through the current environment?
Yeah, it's very interesting. Again, there's an 80-20 rule. So while you do see the quote unquote red states like Florida and Texas pulling back or discouraging ESG, they never were really seriously involved with the question anyway. So, the 80% of states, most of the money in the US is managed in blue states, whether it's New York or California or Massachusetts or Illinois. This is where money is really managed. Yes, there's Miami, but Miami's going to be underwater, so we don't have to worry about Miami, right? Um, anyway, that's a bad joke, but yeah. So the fact that most of the money is managed in states that care about climate change and these issues means that that's still happening, and it is happening. On the other hand, I think the sort of the lack of clarity that the field doesn't provide, we try to help with this, uh, has long caused individuals from knowing how to invest their money and make a meaningful difference. So, yes, there are funds out there and different asset classes. All that work's continuing. It's not like TPG or Brookfield, is managing less assets. They're managing more assets. All the fund managers that get into the space, they're managing more assets in the US. There hasn't really been a significant pullback, but the actual implementation wasn't sufficient in the first place. So it's not like all the money rushed in and then rushed out, right? It's like it hasn't been really happening as much as might be ideal all along, and now there are additional barriers. And the fact that the reality is that under Biden, yes, there was the Inflation Reduction Act. Yes, there were more incentives. But that caused other problems in an odd way. Because Congress was split, the IRA provisions were only able to go so far, and to encourage, for example, a national approach. These incentives, would have disincentivized progress for US companies to seek international opportunities, which is what we need to be doing, right? So that the whole situation was never ideal in the first place. And still, more and more people are alarmed about climate change, but they don't really know how to invest their own money in making a meaningful difference. So there's still this opportunity to better connect people and their concern with better investment opportunities. And whether that's individuals, and in the US, individual investors are very significant, unlike most of the rest of the world. We have the largest concentration of wealth capital. China's second. Those two pools of wealth capital. Actually, the Chinese wealth is more interested in investing in this stuff than American wealth. The interesting dynamics and reports that UBS has come out with over time. So there's a big opportunity here still. I mean, people are confused. They're confused by the media. They're confused by the industry. There isn't enough clarity in what's going on. The data providers don't provide a lot of clarity either. So the industry's been a problem, actually. And yeah, and the current political state of affairs only creates a state of paralysis, I think, to some degree in people's minds. Like they don't know what to do. They don't know what's coming next. Returns for some fund managers weren't great the last few years, even if they were really good for the 5 years prior. So there's a lot going on at the present time that has discouraged progress in a way. So we have to be realistic about that too.
Speaking about the progress, definitely a lot of progresses start at the universities. So I want to ask you a question. You've spoken about how about the gap between sustainability is taught in universities and how it's practiced in the market. What would you like to see change in how you train the next generation of the investors to approach about sustainability? And I believe, at Yale, Brown, NYU, and Harvard. So when you are teaching at these universities, what's your focus in the classroom right now?
Yeah, absolutely. There's a bunch of things to say on this. Uh, I try to be very open-minded in my classes, and my classes have evolved over time. Uh, just teaching ESG is very, very boring. You can read from a book or, the work of the GRI, Global Reporting Initiative, who created the grand ESG taxonomy of every possible environmental, social, and governance data item that you might think of tracking. That's really boring if you teach from that. So instead, what we try to do is to walk students through a multidisciplinary approach where we bring in prominent guest speakers so students can see what's happening on the ground, hearing directly from those who are practitioners. And we also try really hard to portray everything that's happening in the field with an open mind, like what's working, what hasn't worked historically, so we can kind of avoid wasting time and energy on things that aren't effective. Um, and we try to then get students to build their own projects, whether it's building their own portfolios or solutions to climate and other challenges. So yeah, we try to make our classes enjoyable and fun for students, get them to work with each other so they can see the benefit of collaboration, and yeah, have actual tangible work outcomes as a result. So that's been going well. Classes are successful and well attended, popular, and we have 40 students at our NYU class right now, and we'll be doing that again next spring. Excuse me. So that's all fine. But the other thing to say about academic institutions is that if you look across disciplines and practices, there's some pretty big problems actually. And Andy Hoffman's a leading academic. He's written a book about business schools recently that was calling for a complete overhaul of how business schools teach sustainability, to your question. Like, we're not going to fix problems unless we are completely disruptive. So to some degree, perhaps I agree with him to a degree, meaning we should really be open-minded and investigate what will really work going forward. And so, we took an honest look at what's happening in China. Unlike the vilification of China that we see all too often, China's making a lot of progress. How do we actually help with that? Something you don't always see coming out of academic institutions. Most importantly, though, when you look across disciplines, they're often backward looking. And that's to be understood, right? History, archaeology, great books. These are things that have happened in the past, right? The majority of these disciplines are backward looking, and academic analysis and processes are backward looking. They look at data from the past, like, oh, we need 20 years of data to analyze whatever it is. Well, the reality is that climate change in particular is not backward looking. We are all fine. Yes, temperatures changing and there's worse weather, but climate change is yet to be fully disruptive, right? So the future will be different from the past. So academic thinking and processes are completely wrong when it comes to what we need to do to solve climate change in particular. And that's a big problem that the academics in the world have not gotten their heads completely around. As a result, we try to take a bit of a hybrid academic practitioner approach and really look for case studies of what's working that can be deployed and at scale to solve the problems of our time. And there's a lot of skepticism and negativity which is fine, but if it's not in the pursuit of an actual solution, then I don't have a lot of time for it. So, people often overlook what's most important in their critiques, meaning like the intentionality of capital, for example. So, yeah, so we're strong believers that the academic systems that have been built up largely in the West, and China's taking to that approach by and large, like there's an opportunity to do something new and better. And whether it's Andy Hoffman's new book on how business schools need to think differently and provide different types of education, or a really realistic look at, yes, we can learn from what's worked, but we need something different. What does that look like? Can we work within the existing frameworks? What political systems are best? We have to be honest about these things. Is it really helpful to have a political system where every 4 years you have policies that then get disrupted and overturned? What is the best political system? I don't know. I don't presume to know. I don't think anyone should presume to know. But if we go at these things with an open mind and a realistic perspective, then we have a better chance of coming out with what eventually will be, very difficult and challenging conclusions to work from.
What advice would you give to the younger professionals who are looking to enter the sustainability investing field, especially who are determined to make long-term impacts?
Yeah, we've worked with students for a long time now. We're constantly talking to them about this question. And yeah, so it depends on what level you are as a student, right? If you're a high school student, it's one thing. If you're an undergraduate student where we normally teach, it's another. So what's really important is to make sure you have a couple of things. First of all, have a clear sense of yourself and an understanding of what you want to do. Whatever you want to do, it should not only have impact, but be fun. Most people work at jobs that they don't enjoy, and that's a tragedy. So, make sure that you're working on something that is impactful and that you enjoy if you can. And then once you have a vision for where you want to get to in that regard, in say 5-10 years, then figure out what core tools you need, like what capabilities. Some of that can be self-learned, especially these days when there's so many free classes online. But many times, the better students we see, they start their careers at a bank like Goldman Sachs or what have you, or a consulting firm, or a Bain or McKinsey or what have you. And this is fine. I mean, actually, many bright young students will join these firms and work there for a year or two and then leave and try to pursue something a bit closer to what they really want to be working on. And actually, I think those banks and consulting firms are fine with that, because then they can bring the next wave of talent in, right? So if half of those young people who worked till 3 a.m. leave in a year or two, they don't really care. So it kind of works for everyone. So it's kind of like, figure out what your specific strengths are and how you can best apply them to what you want to do, because there's so many different areas you can go into. You can work for a bank or a consulting firm or an NGO or a think tank, or you can invent new things, or you can join a startup. There's $150+ billion of climate startup funding in the US alone in the last few years. Lots of job opportunities that relate. Or you might want to work for a fund manager, or you might want to do, many things. So this field will take many aspects because there's many things we need to do. And it can be a bit feast or famine when it comes to these opportunities. So, we've had students working for the Department of Energy Loan Office who, are likely to lose their jobs because of the current administration. So that can be frustrating. But we also have a lot of students who've started new companies and are doing certainly well enough and becoming advocates themselves for what needs to happen. So, yeah, we're always happy to chat with students about their futures and to make sure you have the right mentors as well.
Very helpful advice. Final question. If you could change one structural feature of the financial system to better align capital with long-term sustainability, what would it be and why?
Yeah, no, it's a really great and important question, and I mentioned it a little while ago. Uh, for me, the way I measure the financial system is whether it's doing what it should is from a standpoint of what is the level of the intentionality of capital, right? To what degree are investment decisions being made with sustainability and or impact in mind as a primary consideration? The goal is to get that to be the majority. It doesn't have to be all, but if a majority of decisions considered sustainability and impact seriously and actually had formulas for that and goals and incentives, that then we'd be really getting somewhere. And it's been a lot of good work over time, so the building blocks are being established. But we really need more than anything is the will of people to want that to happen, right? So we need more than anything people, the majority of people wanting the intentionality of capital to consider sustainability in an adequate way. And we haven't gotten that done. If we got that done, we'd really make serious progress. So actually getting people to want that to happen is the most important thing that needs to be changed.
Thank you, Cary, for joining Turbo Impact podcast.
Thanks again for having me.
Thank you.